You know, for the last couple of years, the financial world has been absolutely fixated on one big, scary story. But what if that story's already kind of over? And what if the real risk has packed its bags and quietly moved to a totally different neighborhood? Today, we're going to dig into a really fascinating shift happening in corporate finance. So, let's just start with a provocative question, right? What if the very thing everyone's been panicking about is actually on the mend, while the investment that looked like a sure thing is now staring down the barrel of a massive disruption? We're talking about a huge reversal here, and it all boils down to one simple but really powerful idea.
And that idea is headline risk. See, this isn't just about the hard numbers, it's all about perception. It's the danger that a constant drumbeat of bad news, true or not, can make a perfectly decent investment feel toxic. It scares people and their money away. You're going to want to hang on to that term, because it is the key to this entire story.
All right, so to really see this in action, we have to rewind a little and look at the asset that has been the star of all the scary headlines for the past few years: commercial real estate, or CRE.
Just think back. From early 2022 all the way through late 2023, the Fed was on a mission, hiking interest rates like there was no tomorrow. And man, did that send a shockwave through the world of commercial real estate. The headlines were just brutal. We all saw them, proclaiming the death of the office and warning about this massive crash that was right around the corner.
And listen, the numbers totally backed up all that fear. Property values took a nosedive, falling about 20%. More and more borrowers couldn't keep up with their payments, which meant delinquencies were on the rise and lenders were facing some very real losses. So what did the banks do? They slammed on the brakes. Loan growth went from a pretty healthy 10% all the way down to just 2.5%. It was, without a doubt, a really painful correction.
But, while all those scary headlines were still grabbing everyone's attention, something was quietly changing under the surface. The market was adjusting, and a comeback story for real estate was starting to take shape.
So the big turning point really came in late 2023. Property values finally started to find their floor as the market digested the new reality of higher rates. Then, moving into 2024, because valuations had reset, CRE loans suddenly started to look like a pretty good deal compared to corporate debt. And by 2025, you could tell the confidence was back in a big way. The market for commercial mortgage-backed securities, well, it hit a record. The bottom line is, the scary headlines, they were starting to fade into the background.
Okay, so just as the fire in real estate was dying down, a new one was just starting to get going somewhere else. That headline risk didn't just vanish, it moved. And its new address? The gigantic market for corporate loans.
And you bet the new headlines are just as wild. Suddenly, we're seeing terms like the SaaSpocalypse popping up, aimed right at the software-as-a-service industry. And the cause of all this new panic? Well, it's the lightning-fast, disruptive force of artificial intelligence.
And this wasn't just about software anymore. Oh no. It blew up into this much grander, scarier idea, the AI eats everything narrative. This is the fear that AI won't just disrupt tech companies, but a whole bunch of other industries. Think insurance brokers, payroll companies, even video game developers. And these are the exact same companies that private credit funds have been lending billions and billions of dollars to. And the amount of money tied up in tech? It is huge. Those publicly traded firms we call BDCs, a full quarter of their portfolios are in software. The broader leveraged loan market, that's got 21% exposure to tech. Even those complex debt bundles, CLOs, have a pretty significant 12% stake. This is a massive, concentrated bet on an industry that's now facing some serious disruption.
And here is the real kicker. Those numbers, they might actually be low. Why? Well, it's because a lot of these software companies don't even get officially classified as tech. Instead, they get lumped in with the industry they serve, like healthcare or finance. So the real risk from AI that's hiding in these loan portfolios, it could be way, way bigger than anyone thinks.
So, you gotta ask yourself, what happens when all this smart money starts to realize the game has changed so dramatically? Well, the money starts to move. We're seeing the very beginning of a great capital reversal, a big shift between these two asset classes.
And the contrast between the two is pretty stark. On one hand, you've got commercial real estate. The scary headlines are fading, values are stabilizing, and its loans are backed by something you can actually touch, a physical building. On the other hand, you have corporate loans facing this immense, uncertain risk from AI, with very few tangible assets to fall back on if things go south.
And this is not just some theory, okay? The money is already on the move. Insurance giant Athene just snapped up a $9 billion portfolio of CRE loans.
Blue Owl is pouring more money into financing data centers. PGM is signaling they're probably going to up their allocation to real estate credit. And maybe the most telling sign of all, banks are actually making it easier to get a loan for commercial real estate, while at the same time, they're making it harder to get a corporate one.
All right, so what does this all mean? Where are we headed now? Well, this great reversal of headline risk is basically redrawing the map for investors, and it's creating a whole new set of winners and losers.
Look, if there's one big thing to take away from all this, it's that the new fears swirling around corporate loans, all driven by AI, could actually be a huge benefit for commercial real estate. Yeah, the very same asset class everyone was running away from is suddenly starting to look like a safe harbor. And here's why that really matters for what happens next. As more of that capital, that private credit money, starts to pivot away from risky corporate loans and flows back into CRE, it's going to create more competition. And more lenders chasing deals usually means better terms for borrowers, which could help fuel the sector's recovery even more. So in the end, the whole story of risk has been turned on its head. The old villain is becoming the comeback kid, and the former hero is facing a really new and uncertain future. It leaves us all with one final crucial question. If AI can rewrite the rules this quickly for the entire software and corporate credit world, which industry is next? Thanks for joining me.